Financial warfare requires no bombs or physical destruction. The process is administrative. 1 minute, trade flows normally, and the next, an entire economy goes dark. This control rests on SWIFT. It is a messaging network carrying specific instructions banks use to trade. When these lines are severed, the underlying money is paralyzed. A disconnected bank keeps its assets, but loses all ability to communicate outside its own borders. By controlling this administrative bottleneck, the system can freeze billions in assets and halt national exports without seizing a single physical vault or deploying a single soldier. It is a weapon that operates entirely through silence. In 2012, this was deployed against Iran. 30 banks were disconnected overnight. Within a year, oil exports dropped by 40%, and the rial lost 80% of its value, forcing the government back to the negotiating table. Russia watched the Iranian collapse and used the 8 years following the 2014 annexation of Crimea to prepare. The Russian central bank began building a domestic messaging system, knowing their own disconnection was a matter of when, not if. When the disconnection finally hit in 2022, 7 Russian banks went dark internationally. The ruble lost nearly half its value in 24 hours, and the central bank raised interest rates by 11.5 percentage points to stop the freefall. The institutional damage immediately reached the streets. People found themselves standing in long queues at ATMs, uncertain if their domestic bank cards would even function for the simplest daily purchases. Seeing a major economy's stock market shut down and its currency lose half its value in a day changed the calculation for every unaligned nation. It provided a direct incentive for countries across the BRICS bloc to start building payment systems that don't pass through a Western choke point. China's CPIPS is the largest of these alternatives. It connects over 1,600 financial institutions across 180 countries, aiming to establish a global architecture independent of Western control. However, the majority of CPIPS transactions are not truly independent. The BRICS nations have openly discussed a shared payment infrastructure, but the project is stalled by competing interests. China wants the yuan at the center, while India prefers neutrality, and Saudi Arabia balances its hedging with its ties to Washington. These alternatives struggle because while the technology is easy to replicate, the global incentive is not. Most banks in Japan, Germany, or France see no reason to abandon a functional global standard just to join a messaging network run by a different foreign government. With state-run networks facing gridlock, some sanctioned nations turned to cryptocurrency. They looked to Bitcoin as a borderless ledger that operates by math rather than the dictates of a central bank. This transparency is actually a hurdle for those evading sanctions. Because the blockchain is a public ledger, intelligence agencies can trace the money and map out financial flows more permanently than in the traditional banking system. There is also the issue of commerce. It is nearly impossible to price a multi-month contract for steel or oil when the currency's value can swing 20% in a single week. For an economy under pressure, Bitcoin offers a way to move value, but it lacks the stability to support industrial trade. It serves as a tool for moving funds between individuals, but not as a reliable foundation for a nation's commercial infrastructure. This led sanctioned economies towards stablecoins, digital tokens that carry the value of the US dollar, but move on blockchain rails outside the SWIFT network. Russian and Venezuelan entities moved heavily into Tether to settle international trades. By using digital dollars, they believed they had found a way to maintain the stability of the dollar while bypassing the reach of Western banks. That belief was tested when Tether froze $28 million from a sanctioned Russian exchange. The action was taken at the direct request of the U.S. Department of Justice. This is because the dominant stablecoins hold their reserves in U.S. Treasury securities. To keep those assets, they must comply with American law. If the Department of the Treasury orders a freeze, the stablecoin issuer has to pull the digital leash. This creates a deep irony for sanctioned nations. In their attempt to escape the dollar, they are buying digital tokens that are backed by and directly finance American government debt. There is no truly neutral network. By moving off SWIFT and into digital dollars, these nations haven't escaped the system. They have simply moved into a different, more transparent part of the American financial architecture.